Well, welcome to our High Rock clients and any other listeners, and thanks for taking the time to tune into our weekly webinar where we will talk about what we see happening in the global economy and financial markets and the world of wealth management, and how all of this impacts our decisions on the best courses of action for our investment strategies. We are recording this webinar so that those who can't join us live can tune in when it's more convenient. I'm Scott Tomlinson, and I'm joined by my partner and colleague, Paul Tepsich, the founder of High Rock. Our financial planner, Bianca Tomlinson, is also on the call. We will have a question and answer period at the end of the call, so if anyone has a question about any aspect of wealth management, we invite you to feel free to ask us questions. If you are a first-time listener and would like a little more information about our private client services and our disciplined investing strategy, we have a separate introductory webinar that will provide you with this on our website under the About High Rock tab. So what's happened since our last webinar? Well, let's get right to the financial markets. Not much change in fixed income markets, although the Canadian Preferred Share Index moved lower, basically because traders are worried about lower interest rates if the Bank of Canada cuts the bank rate. However, with dividend yields above 5.5%, existing preferred shares are starting to look more attractive, especially in light of lower interest rates to come if they should. Canadian and U.S. 10-year yield spreads were unchanged on the week at 87 basis points. That's up a little bit from 2 weeks ago at 85. Basically, the spread widening has been the result of diverging economic results between Canada and the U.S. At the moment, though, Canadian 10-year yields have hit a record low near 1.2%. Well, volatility, one of our key themes for 2016, continued over the course of the last week. Our benchmark World Equity Index had another rough week and is now lower by a little over 8% on the year. Germany was the worst performer since last Tuesday. Not a single equity index that we follow here was positive for the second week in a row. Volatility was higher last week, well above its longer-term averages, but well below the spike last August. Global economic uncertainty and diverging monetary policies have left investors fearful of risk assets. CNN Money's Fear and Greed Index hit a low near 10 late last week, representing extreme fear. It ticked a little higher today. Amidst the fear, our benchmark World Equity Index hit 50.29, which is a 20% drop from the highs last May, before finding some buying support near last August lows. As we suggested last week, this comes as traders who had sold the market short to buy back their positions, taking their short-term trading profits and taking advantage of those who panicked to sell. True to the volatile nature of markets these days, this has all happened at a very quick pace. In all likelihood, there should be a pause in the activity until the next move becomes more clear. The next move will depend on whether this draws more buying from long-term investors who think that these prices represent value, or whether they use any upticks in the market to sell as they further reduce exposure to risk assets. We will be watching this closely. For our High Rock models, we have lowered our buy prices for the time being until we can ascertain whether the market has greater downside momentum and there is still more selling to come. Well, oil prices dropped another 6% since the last time we spoke and are more than 20% lower on the year. Natural gas was the worst performer since last Tuesday, lower by 7.5%. Well, oil is still a key focus for financial markets. Unseasonably warm weather and rising supply will keep the crude oil market oversupplied until at least late 2016, said the International Energy Agency in its monthly report on this morning. Warm winter weather around the world cut global oil demand growth to a one-year low of 1 million barrels per day in the fourth quarter of 2015, down from a near 5-year high of 2.1 million barrels per day in the third quarter. The IEA left its estimate of growth in global demand for 2016 unchanged from its previous monthly report at around 1.2 billion barrels per day. Now, oil prices have fallen to their lowest level since late 2003, tumbling below $30 a barrel after OPEC said in December it would not cut output to arrest the price slide despite global oversupply. We conclude that the oil market faces the prospect of a third successive year when supply will exceed demand by 1 million barrels per day, and there will be enormous strain on the ability of the oil system to absorb it efficiently, said the IEA. With the world economy slowing, the IEA said it had cut its forecast for 2016 OPEC crude oil demand by 300,000 barrels per day. Iran has said it will raise output by an initial 500,000 barrels per day now that international sanctions have been lifted. But the IEA said it believes the increase will be a more modest 300,000 barrels per day by the end of the first quarter of 2016. The IEA is sticking with its forecast for a decline of around 600,000 barrels per day in non-OPEC output, which it said had been surprisingly resilient in the face of tumbling crude oil prices. And the Bloomberg Commodity Index continues to fall. And the Canadian dollar was once again lower, touching lows not seen since April of 2003. Good for the export economy, not so good for the snowbirds. Well, the World Equity Index is comprised of about 52% of U.S. companies, so we keep a close eye on what is happening in the U.S. economy. The U.S. Federal Reserve raised interest rates in mid-December, citing that they saw improving economic conditions and expected inflation to move toward their target 2% level, and that future increases were expected to be gradual. They meet and will announce any changes to their outlook on Wednesday, January 27th. We do not expect any interest rate changes at that time. With their optimistic economic outlook, Federal Reserve governors indicated in December that they expect an average of 4 interest rate increases in 2016. We are not as optimistic as the Fed and see fewer, if any, interest rate increases until there is better news on the U.S. economy, which, for us, at the moment, does not appear to be showing any particular signs of strength. In fact, remembering that the U.S. consumer represents approximately 70% of the economy, it is important to note that retail sales proved disappointing in December, down 0.1% and well below expectations. Weak apparel sales, which in this report fell a very steep 0.9%, were the catalyst, as well as electronics and appliances also showing contraction. December winds up what was a not so great year for the nation's retailers. Total sales rose only 2.1% in the year, the smallest gain since 2009, and well down from 3.9% in 2014. Excluding motor vehicle sales rose 0.9%, far lower than 2014's 3.1%. There are, however, some positives in the report, including another strong gain for restaurants, up 0.8%, also another gain for furniture and home furnishings, up 0.9%, in strength that confirms ongoing improvement in the housing sector. But sales at non-store retailers, or as we know it, online shopping, rose only 0.3% for a second straight month. Moderate gains that do not confirm anecdotal reports of unusual holiday strength for online shopping. A leading indicator of U.S. economic growth is the data for those reporting new unemployment claims, which are compiled weekly to show the number of individuals who filed for unemployment insurance for the first time. While the week-to-week data can be somewhat erratic, the 4-week moving average, which smooths it out, and that would be the red line here, has been climbing since October. Fourth quarter U.S. GDP expectations continue to be revised lower, leaving plenty of uncertainty as to the validity of the 2.5% GDP growth that is expected by the U.S. Federal Reserve in 2016. Around the rest of the world, The pickup in global growth is weak and uneven across economies, with risks now tilted toward the emerging markets, says the IMF's latest World Economic Outlook update. Advanced economies will see a modest recovery, while emerging market and developing economies face the new reality of slower growth. The update now projects global growth at 3.4% this year and 3.6% in 2017, slightly below the forecast issued last October 2015. This coming year is going to be a year of great challenges, and policymakers should be thinking about short-term resilience and the ways they can bolster it, but also about the longer-term growth prospects, said Maurice Obstfeld, IMF Economic Counselor and Director of Research. Growth in advanced economies is projected to rise 2.1% and to hold steady in 2017, a slightly weaker pickup than that forecast in October. The report suggests that overall activity remains robust in the United States, supported by still easy financial conditions and strengthening housing and labor markets. But there are also challenges stemming from the strength of the dollar, which is causing the U.S. manufacturing sector to shrink marginally. In the euro area, stronger private consumption supported by lower oil prices and easy financial conditions is outweighing a weakening of net exports. Growth in Japan is also expected to firm up in 2016 on the back of fiscal support, lower oil prices, accommodative financial conditions, and rising incomes. Emerging market and developing economies are now confronting a new reality of lower growth, with cyclical structural forces undermining the traditional paradigm, the growth paradigm. Growth forecasts for most emerging market and developing economies reveal a slower pickup than previously predicted. Growth is projected to increase from 4% in 2015, the lowest rate since the 2008-2009 financial crisis, to 4.3 to 4.7% in 2016 and 2017, respectively. Well, comparing our themes for 2016 with the IMF's forecast, according to the report, there are important risks to the outlook, which are particularly prominent for emerging market and developing economies and could, in fact, stall global recovery. Now, these risks relate mostly to the ongoing adjustments of the global economy, namely China's rebalancing, lower commodity prices, and the prospects for the progressive increase in interest rates in the United States. They include the following possibilities: a sharper than expected slowdown in China, which could bring more international spillovers through trade, commodity prices, and waning confidence, a further appreciation of the dollar, and tighter global financing conditions, which could raise vulnerabilities in emerging markets, possibly creating adverse effects on corporate balance sheets and raising funding challenges for those with high dollar exposure. A sudden bout of global risk aversion, regardless of the trigger, could lead to a sharp further depreciations and possible financial strains in vulnerable emerging market economies. An escalation of ongoing geopolitical tensions in a number of regions, which could affect confidence and disrupt global trade, financial flows, and tourism. New economic or political shocks in countries currently in economic distress, which could also derail the projected pickup in activity. On the downside, further declines in commodity prices would worsen the outlook for already fragile commodity producers, and widening yields on energy sector debt threaten a broader tightening of credit conditions. On the upside, the recent decline in oil prices may provide a stronger boost to demand in oil importers, including through consumers' possible perception that prices will remain lower for longer. All in all, there is a lot of uncertainty out there, and I think that contributes to the volatility, said the IMF's Obstfeld. We may be in for a bumpy ride this year, especially in the emerging and developing world, he said. Well, this does factor in very much with the themes that we have presented over the last couple of weeks for 2016. So it does give us some credibility in the thinking and in our thinking. Again, we have to be very cognizant of all the potential risks out there, and we must protect our clients' portfolios from those risks as we move forward. Well, euro area companies represent about 16% of the world equity index. The European Central Bank eased monetary policy on December 3rd, but it was less stimulative than the market had expected. The European Central Bank will announce their latest interest rate policy on Thursday of this week. Japanese companies represent 8% of the world equity index. The Bank of Japan will announce their latest decision on interest rates on January the 28th. Companies in the UK represent 7% of the global equity index. Last week, the Bank of England Monetary Policy Committee voted by a majority of 8-1 to maintain the bank rate at 0.5%. Policymakers said the outlook for growth and inflation weakened and noticed past appreciation of the pound. Weak global inflation and restrained domestic cost growth are also dragging consumer prices down, in addition to falling oil prices. Chinese companies represent 2.5% of the world equity index. Well, China's central bank did a major injection to the financial system in early January. And as announced today, the Chinese economy grew an annual 6.8% in the fourth quarter of 2015, slightly lower than the 6.9% in the previous quarter and the weakest since the first quarter of 2009. The figure was in line with market expectations as strength in services and consumption offset weaker manufacturing and exports. For the full year of 2015, GDP expanded by 6.9%, lower than the 7.3% in 2014, and the weakest growth in 25 years. The government targeted the economy to expand at around 7% for the year. In Canada, where companies represent 3% of the world index, the Bank of Canada will announce its latest interest rate decision tomorrow. Markets have priced in a 60% chance that the bank may lower the bank rate at this time. Okay, what do we see coming on the horizon? Well, bond markets tend to lead other financial markets, so let's check in there. Government bond yield curves remain positively sloped and slightly steeper in Germany as the euro area economy appears to have stabilized. Little change in the US, UK, Canadian, and Japanese yield curves. Historically, high-yield bond markets lead equity markets. Well, 2 weeks ago, the gap was quite wide, suggesting that equity markets might begin the year with further selling. Last week, the gap had narrowed considerably, and this week it has closed completely. And in fact, high yield has ticked up ever so slightly, a little ahead of equities. This may be a sign of a temporary bottom in equity prices. We will keep a close watch on this leading indicator, which has successfully projected both recent collapse in equity prices in August and then the first half of January. But when investors buy stocks, they buy a stream of future earnings. The price-to-earnings ratio represents a metric to measure stock prices relative to earnings. The 10-year average price-to-earnings ratio is 14.2 times. The 12-month forward price-to-earnings ratio is currently at 15. Last week it was at 15.7. At the equity market highs back in May, it was at 17.1. So equity prices, that would be the green dotted line on the chart, have recently become cheaper in the first couple of weeks of January. But until they move below that blue line, we think that they are expensive, as is usually the case and was so last year to no avail. Analysts are predicting significant increases in earnings and revenue growth in the second half of this year. In terms of earnings, the estimated growth rates for the first quarter of 2016 and second quarter of 2016 are negative 0.6% and positive 3.1% respectively. And while the estimated growth rates for the third quarter of 2016 and fourth quarter are 7% and actually 14.7%. Now, more recently, those estimates have been revised significantly lower. We are suspicious of the overly optimistic expectations at this moment. So as for the other metric that we like to look at, enterprise value to earnings, the S&P 500 companies are valued at current market prices at 11.5 times. The long-term average is 9.7 times, and that is significantly more expensive for our tastes than we would like them to be. Also, when investors borrow to invest, it can drive stock prices higher. When they pay down their loans, they tend to sell. So margin debt data tends to provide an indication of equity market direction. Margin debt turned lower last May, so it is something that inspires our current level of caution. When the spread between large cap markets like the S&P 500 widen over the small cap markets like the Russell 2000, it is historically a sign of stock markets that are rising on the strength of fewer and fewer companies and is considered to be unhealthy. That had been happening, and there had been a reasonably wide gap between the S&P 500 and the Russell 2000, but as markets have fallen over the last couple of weeks, that gap has narrowed considerably, which to us means that we may be close to a temporary bottom. This is in line with our belief that equity markets have become at least temporarily oversold. So what does it all mean? Well, our discipline, as we often refer to it, is at all times to protect our and our clients' capital, and especially so when we see the warning signs of potential problems. We are not alone in this thinking. Cash and cash equivalents are important defensive assets. We cannot stress this enough. So we are carrying greater than normal cash balances in our models at the moment and waiting for asset prices to get more reasonable price points before we commit capital for the long term. Our High Rock models are built to incorporate the need for diversity and balance with fixed income, global equity, and tactical mid and small cap companies. As volatility increases, the cash in client accounts, the underweight nature of our exposure to equity markets, and the negative correlations between equity markets and bond markets helps to mitigate the impact of volatility in our portfolios. So far this year, our global benchmark equity index is down about 8.5%, as I mentioned earlier. A typical 60% equity portfolio and 40% fixed income portfolio built with our models is down somewhere between 1.5% and 2%. This is a significant mitigation of risk and volatility. High Rock clients should have received their quarterly updates today for the fourth quarter of 2015. As always, we remind you that we are available 24/7 if you wish to discuss your situation in greater detail. Okay, what's on the agenda for next week? Well, tomorrow starts the World Economic Forum in Davos, Switzerland. Also tomorrow we'll get the UK's December unemployment rate, the US December Consumer Price Index, and as I mentioned earlier, the Bank of Canada's interest rate decision. So stay tuned for some news there. On Thursday, the European Central Bank interest rate decision. On Friday, we'll get the UK December retail sales and the Canadian Consumer Price Index. On Saturday, the World Economic Forum in Davos ends. On Sunday, we'll get the Japanese December balance of trade, and then it's pretty quiet for Monday and Tuesday for markets to digest all of the news that we'll get over the next few days. Okay, that's it for today's discussion. So if anyone who is listening might have a question, this is the time to voice it. All right, I guess I gave everybody enough information, so no questions at this point. But as always, if you do have questions and wish to email us, we would be more than happy for you to send them. We would also love to get your feedback on these webinars, what you think is good, what is not, or what else you might like to see us cover on these calls. As always, thank you for taking the time to tune in. Have an excellent rest of the week and a great weekend. We will return with another webinar next Tuesday. This is Scott Tomlinson signing off.